Good afternoon, everyone. Welcome to our panel. As just announced, liquidity amid record volatility and certain uncertainty. I think our panel will, we're aiming to help you understand how market conditions have affected trading activity, liquidity, etc. during the year, why relationships are still very important, and what's going to be the key for 2026. And again, good to have a slot keeping you guys from food and, well, also listening to the budget, of course. So let's dive right into it. I'll just ask my panelists to introduce themselves as a starter, please.
Hi, I'm Andy Biggs. I'm the CEO of Finalto Trading and Group Head of Risk and Trading for Finalto. We're a multi-asset broker.
Hi, I'm Fazana Nanji. I am the EMEA Head of EFX Sales at HSBC.
Hi, Rich Turner, Senior Trader, Insight Investment, predominantly trading FX, but pretty much trade quite anything you want.
Jeremy Smart. I run global distribution for XTX Markets, a leading non-bank market maker based in London, proprietary trading firm.
Hi, I'm Lee Goldfarb. I am not John Murillo, but I'm standing in his place. I am the liquidity sales trader at B2 Prime, and I am part of the liquidity team for the B2B group.
Oh, thanks, everyone. So I think we'll just start off with a bit of an icebreaker. Now, can I ask, what do you think, from your perspective, of the most memorable moment of the year in front of the screen? We look at things like volatility, tariffs, etc., etc. Andy?
Look, I think there's an awful lot to unpack for the year. You've mentioned tariffs, volatility, and generally the uncertainty that we've seen this year. I'm going to zoom on one particular moment for me. You asked about one moment in front of the screen, and that was us attempting to roll silver on one day and it being extremely hard to do. And there was about a 10-minute time period where we were looking at physically settling the silver position that we had, which was not something we were experts in doing and didn't really want to do. So if there's a moment of uncertainty that stands out for me, it was definitely the silver rolls.
Right, Fazana?
I mean, I would definitely echo that we have seen a lot of uncertainty throughout the course of this year. It seems to be continuing, but certainly the highlight for me was the moves that we've seen in dollar yen, particularly because you saw a big change in the spreads and how people were trading. But the other thing that was quite important to me is I was in Japan in October, excellent exchange rate and great shopping.
Thank you. Rich?
So I think from me on the buy side, trading FX every day is a challenge, and it's uncertain. It's very interesting. Keeps me smiling, keeps me happy, keeps me unhappy. But I think if you're talking about things in front of the screen and looking at things in front of the screen, it was definitely England beating New Zealand a couple of weeks ago.
Absolutely.
Obviously, the day that my bonus hit the bank account was a good day and quite memorable for me. But I think probably the day that Trump rolled back tariffs earlier in the year, and the U.S. equity market jumped like 8% in a heartbeat. I mean, that's pretty extraordinary stuff. What's pretty disappointing is how little FX moves when that happens.
You forgot my birthday, Jeremy.
Sorry, I forgot your birthday. Yeah, Ian, that was extremely memorable. March, was it? Or
June.
Yeah, there we go.
I'd have to echo that October was a particularly interesting month. We were both in Dubai and Hong Kong at a conference, but at the same time, we had silver rolls just being rather difficult and having to explain that to retail clients who might not necessarily be able to understand the underlying market very well. Along with gold falling 5% basically in a day. All of these things lead to interesting conversations with clients trying to explain what's happened and how the market is developing. We specifically do a lot of white labeling, and because we do white labeling, we are exposed to brands who then need to explain things to their retail clients. So there's a big gap there between knowledge. It's not just institutional that we're looking at. We're looking at clients who are running brokerages, but their underlying clients might not be sophisticated. So there's a lot of communication that has to undertake to explain these very not normal market conditions, but the market behaving in the way the market does. But you need to be able to relay it further down the line in a way the clients can understand.
Interesting. Thanks, everyone. And I think we'll come back to that subject, actually, the intersection. Now, in terms of the actual ecosystem, in all these volatile moments, silver, dollar, yen, etc. How do you feel that the FX ecosystem itself has performed this year? In terms of execution, available liquidity, and stuff like that. Go to Jeremy, please.
Well, I think the market continues to perform reasonably well, but I think it shows signs of underlying weakness actually in market structure. So the big thing that we've seen over the last 2 or 3 years in particular, but I mean, it's a trend that's been going on for a long time, is generally a lot less risk taking in banks, a lot less capital applied to markets, businesses in banks, but particularly into relatively low yield products like FX. There are obviously a number of non-banks in the market, but generally they are, with the exception of us, most of them are not really particularly client-facing, and they are essentially dominating along with us in the primary markets. And the primary markets have moved a long way from the traditional cash primaries of EBS and Reuters over to the CME. So a lot of price formation and a lot of liquidity exchange between primary dealers really now happening on the CME. The primary cash markets are strained for sure in terms of liquidity. But once you get a moment of crisis, then these two markets have to kind of come back together. So you've got banks who are supplying liquidity fundamentally into most of the client space. You've got non-banks who are really doing most of the price formation and a lot of the initial liquidity creation. And then really what's happening is these two markets can kind of almost inhabit separate worlds. When a crisis happens, you desperately need these markets to come back together, because the banks who all run internalization models pretty successfully suddenly need to externalize a lot of risk. And when they need to externalize a lot of risk, they're doing that onto primary cash markets, and they need the non-banks who are trading in the futures market to be able to take that liquidity in order to facilitate the smooth functioning of the market. Otherwise, what you're going to get is people on the banking side hitting risk limits and no longer being able to provide liquidity into the market. And that is a danger, because futures and cash are not homogeneous, right? And there is a basis. And as we've seen in gold, for example, where there may be some very specific reasons for basis moves, but if anyone can really explain the basis moves to me that we've seen this year, then I'd love to hear what their explanation is, because no one that I speak to really seems to know what that is. And that's a risk for FX, the futures market and the cash market being bifurcated, but also critically important that they function together in order to maintain liquidity in crisis situations. And what we had this year was not a crisis, right? It was just a very volatile market. But in a crisis, I do worry about the market structure.
Thanks. And Fazana, from a bank perspective.
I mean, I think we've seen a bit of a shift in terms of how clients view their partnership with banks. And I will focus particularly on the HSBC relationship, where I think it's about creating a partnership. And this is where things for me have really changed, helping clients navigate the more complex environments, being with them as they try to execute, whether you're trading voice because the markets are too volatile, or you're coming down the electronic platform. It's really about creating that partnership and almost redefining what good looks like these days. I think clients would very much say they partner with banks to help them through these more volatile circumstances. And that's where I think the relationship still really stands the test of time, to make sure that we can help them get out of any difficult situations.
Rich.
Yeah, so at Insight Investment, we're heavily involved in relationship management and having a very, very good relationship with all of our banks. And I think certainly over this year and previous years, we've done a lot of working with the likes of HSBC on how we execute in the marketplace. A lot of that is actually really pushing ourselves to understand market structure better. Alluding to Jeremy's point about the disparity between futures and OTC, we need to understand what that is in crisis, what that means in functioning market, what that means. And so for us, with the banks, teaming up with them, learning more and more about market structure to the point where we do know what we're doing when we go to actually execute is very, very important. And one other key thing is looking forward to seeing, what things are around the corner, what technology can we use, what special ways of trading are there that we can use. And so for us, it's very, very much driven by the relationships we have with our banks and furthering them as best possible that we can. And part and parcel of this as well is an education piece. So it's not just educating ourselves, but it's educating our peers and trying to educate the wider FX space as well.
Great. Andy, what about from your side?
I think from my side, I'm quite surprised at how well liquidity's held up this year. I mean, it's yeah, not been a crisis as Jeremy says, but we've seen $400 move in gold over 2 days, and liquidity held up. We never really saw. Yes, spreads went wider. Yes, there were spread spikes, but we never saw liquidity completely vanish. We were always able to execute. Especially with things like the EFP blowout in gold, it was interesting. If you compare it, I know it's slightly different, but compare it back to COVID when the Swiss refiners shut, and all of a sudden we did not have any gold liquidity through to now. The volatility, it stood up. It stood up, and I think a few years ago we were on a similar panel talking about whether algorithmic trading would increase flash crashes, and I think we've seen some real prime examples of where it could have done, but it hasn't. So I think it's quite nice to see that coming through. Some of the concerns we had a few years ago were unfounded.
It's nice to see the market feels like it's generally held up. Lee, anything more on your side?
So for us, if we look at it from the retail trading space, I think the hardest thing is that a lot of clients, they back test their strategies, but they don't really understand how the underlying products are composed. So when you have a situation where the futures market is dislocated, there's not a lot of spot liquidity, they're expecting execution to continue to be in the way that their back testing models work. And it just simply doesn't work like that. If you're running a martingale strategy and spreads start to differ from what you historically believe they should be, then that strategy becomes very intensive on the equity use. So what we see is that there's a very big differentiation between people who have institutional background, knowledge, and understanding of how the markets actually are composed versus viewing them as a ticker or just, a number on a screen that you can back test and you can run a model and the model says that I should be able to make money out of it. And I think that is something that this year's become very much to the fore, because we've had situations in multiple different products where that dislocation between it being just a pure numbers game and it being a real underlying market that needs to work in certain ways. Every time Trump talks about tariffs and people are worried about what's going to happen with the gold tariffs, we see these kinds of situations where if you just look at it in terms of a product on a screen, you don't really get the full picture of how these products are composed and where that liquidity comes from.
Okay, thanks. And that just shows how important panels like this and events like this in terms of sort of bringing together that retail institutional intersection are. And then on that note, what are the sort of key factors, and I'll probably start with you, Andy, in terms of, ensuring a sort of smooth modus operandi between the prime of primes like yourselves and, LPs, banks and non-banks?
I think it's transparency, but backed by analytics and a deep understanding of each other's business models. It goes back to it being a partnership. And having that transparency, having the analytics to kind of back up that transparency and having an understanding of each other's business models creates trust ultimately. And us as a prime of prime, we are trying to handle lots of different types of client flow. So we want to create sustainable liquidity pools for each client type. And that's where the partnership comes in for our bank and non-bank LPs to trust us in order to use their liquidity correctly. And ultimately for us to be able to trust them to ensure that they're going to continue pricing us in the most competitive way possible. And I think although a lot of FX liquidity is now almost completely automated, there's still quite an important human touch where the humans can override the algorithms and effectively say, based on some qualitative information, we will price at a certain level for a certain period of time. So it is a partnership. There's lots of communication that happens back and forth to just ensure that that everyone knows what's happening at all times.
Okay, and Fazana, about yourself?
I mean, I would definitely go back to the partnership, where I do think it's very important because the structure of a prime of prime is so different to an asset manager, for example. So because there isn't sometimes a visibility onto the end client, that's a pretty hard dynamic to navigate. So I do agree that the closer we work together, the better we can provide good liquidity continuously. But it's just a very different dynamic in comparison to the larger institutional houses that will look at flow very differently.
It's a theme of relationship and working together comes through here. And Jeremy, in terms of your relationship type,
I mean, look, the liquidity will match exactly the flow profile that you get. So, if flow profile looks terrible, and crosses zero in short order, then prices are going to be wider, liquidity is going to be less, et cetera, et cetera. It's just a straightforward relationship. And as Andy mentioned, it's becoming more and more automated, so that the more and more we're asking clients like Andy to just send us data. We'll ingest the data and just make those changes automatically without a human even necessarily being involved in that. Yes, we can override it, as Andy mentioned, but I think one of the key things for us when we're pricing into the retail market is we want to be able to show our skew, right? And that's really, really important. So for us, the ability to show skew into retail is critically important part of our hedging, of any algos that we run on behalf of clients, et cetera, because the difference between me showing skew into, say, the retail market or into, say, systematic hedge funds, be they sort of more retail in nature or more institutional, is they will trade because I show them skew, rather than, when I show my skew to a bank, for example, that we are pricing, then they will trade. They may trade when they have a trade to do, and I might happen to be top of book, but I really need that skew out there. But the problem is, skew leakage is a massive problem, right? And alpha leakage generally is a massive problem. So we have to work with clients to make sure that we price them with a lit price, which has no skew in it. And we price that lit price, which they can then use in onward price construction to their client base, etc. But then we give them a full skew feed that they can hedge on, so that both parties get the benefit of the full amount of skew without us, leaking that skew to someone, running a systematic shop in, I don't know, Jordan or somewhere like that.
Skew safety is paramount, and we've seen that grow. And Lee, yourself, in terms of managing those bank or the NLP relationships.
So for us, the main and most important thing is that we have two main relationships. We have the underlying customer, who will have clients trading on the specific flows, and they themselves might not be particularly accustomed to understanding crossing the zero and skew safety. And then we have the LPs on the other side. So as in the B2 Prime group, a lot of what we do is understanding what is the business model of the underlying client, understanding appropriate LPs to put that kind of business in front of, and having a good level of education. I'm also involved in the FX Dealer Academy, which is run by Alina Penderson. And that is, again, to equip brokers with the knowledge of, how to read markouts, how to understand skew safety, how to construct their business in a way that LPs can price it and can understand it. But also, some clients might have flow that we know is going to be challenging. So being proactive, creating pools specifically for that challenging flow, where LPs know what they're standing in front of, what they're looking at, and are willing to execute against it, is really paramount. Because at the end of the day, as a marketplace, we need to facilitate lots of different kinds of clients with very different behaviors. And from retail, you might have someone come onto a retail platform and start trading very large ticks and doing quite scalping style behaviors, which the LPs don't like. But that might represent to the underlying client a fantastic client. They put a large deposit, they're doing large trades, so they're very happy with them. So there's a lot of communication that needs to happen on both sides for people to understand what's happening. And that's something that I think is particularly powerful in the B2 group, is the fact that we have all of these pools and that deep market knowledge to construct them and have fantastic relationships with our LPs to be able to execute that. Because actually what we're looking at is having multiple strategies running through these APIs, where one pool might be specifically for very benign retail, one might be for much sharper retail, one might be for stuff that we know would be quite toxic to certain LPs, but some LPs might have an interest in it. So there's a lot of communication.
Yeah, it comes down to communication. Rich, any?
Yeah, so I think as a trader on a big asset management firm, what we try and achieve is, when an order hits our blotter, we want to find out where the axes are. So part and parcel of our relationship with the banks, liquidity providers, is to enable that to happen in a very, very quiet manner. So if we find the other side of the price and it's at a preferential price, we want to shake hands and trade and move on with absolutely no information leakage there. So for me as a trader, that's the challenge that I have, is trying to keep my flow as clean as possible. Now, on the basis of that, how do I prove that? Well, I prove that by a lot of data analytics. So we have to be cognizant of the fact that when we do trade, we can deep dive into the post-trade execution, look at decay curves and so forth, and make sure that we are doing the right thing. So there's an element of transparency, which is also important as well. So it's relationship, trust the people you're trading with, keep your footprint minimal, and then it's about the transparency post-trade.
That actually comes on to the next, with one of the key themes and big key themes of what we've been discussing is the human value. Now, obviously, relationship has been a theme throughout these conversations, but relationship on top of automation. And in terms of, you know, what do you think are the key skills and the craft that the FX marketplace and traders or clients should need to have today, firstly, and then secondly, in terms of AI, what kind of things are you guys using it for? We were talking about this earlier, actually, and where would you not trust it at all? Andy, we'll start with you.
I'll take the AI question. I think so. AI has become somewhat ubiquitous in a very, very short period of time. I mean, walking around the office, the number of ChatGPT you see up is sometimes slightly worrying. So I think you know, there are positives. So our BI tool now uses a natural language query, and that's democratized data among the firms. So people that couldn't do an SQL query can now access data. So it's freed up some quant time. It has enabled people from the sales or operations to interrogate data and get useful information out of it that then enhances our ability to sell or operate correctly. But there's also downsides. So we see a lot of AI slop. So a lot of stuff in the inbox that you can tell was written by AI, and I'm worried you get to a world in which you get AI slop sort of written, and then you're summarizing it using AI, and the sort of the heart and soul of communication is somewhat gone. I hope that's sort of not going to be the case, but you can certainly feel that a little bit more. It's extremely useful for things like content marketing. We use quite a bit of AI for. And amongst the firm, particularly on the trading side, we don't use LLMs, but we'll use quite a bit of machine learning. And then the LLMs come in terms of speeding up processes of everything to do with development, and then using the machine learning for our sort of pricing and trading. So we've seen what used to take a senior and 3 juniors, you can do with a senior and AI. So it does enable us to, I think, get a lot more done with the same amount of people, which is positive for us.
Sure. Fazana?
I think AI has been great in the workplace. To your point, you can get it to automate a lot of workflows, which is where I really think its strength currently lies, getting rid of manual workflows and making sure you can add that automation. It is incredibly good at data analytics. And I think when you think about the client journey in terms of pre-trade analytics, post-trade analytics, AI has really found a good spot in between that. However, I do think there is relationships cannot be underestimated, because when you are having volatile markets, you need to know who that person is on the other side, so you can work with them to make sure that you can help them, kind of guide them through the markets. There's always going to be a relationship that has to be had, and that's what helps us build the better tools and makes the entire relationship work to the most optimum.
Cool. Rich?
Yeah, so I think automation is key. You know, we're looking at many ways in which we can automate, but to Fazana's point, it's also having a very good relationship with the people and that you trade with, because you've got to be able to automate for everybody. Now, in terms of, you know, when orders arrive on my blotter that are quite tricky, I can't automate them because the limits that the banks have won't be big enough to handle the order I'm going to ask them for. So automation is good in terms of how it's going to work, but at the minute we haven't got it fully automated, and things like that are still causing us problems, which means, guess what, we have to go back to basics and do it on an IB chat, do it manually, which, you know, it risks people at Insight. It does keep them, you know, does make them worry, because there is still a manual process. That said, you know, I think we rely on the banks that are pricing to us heavily to improve their execution, and Jeremy's team as well. From an AI perspective, we rely on them doing the work to ensure that the price that we're getting is a really good price, and that's where AI has played a massive part in FX in the recent times, which I'm a big proponent of. But I still think that we're in an ecosystem where there is still quite a lot of manual processes. So in the example, when I ask for a sizable swap, guess what? It still goes to a voice trader. And so, you know, I'm not sure we're in a position yet that we can automate that. And you dig into why that goes to a voice trader, And the answer is very, very deep rooted, and there's a lot of weeds there. I don't think we've got enough time today to talk about that. That's probably a separate conversation.
Jeremy.
Sort of good humans are valuable. Bad humans are generally not. That would be my general view on humans. AI is like the center of our firm, right? I mean, we use deep learning in order to construct the prices that we generate. We trade around 25,000 different instruments every day, equities globally, commodities, futures, currencies, etc. Some fixed income as well. And in the world of deep learning, you're essentially feeding a machine with data, and you're not giving it any specific parameters. You're not saying this data is FX or this data is equities. You're just feeding the data into a machine, and the machine is coming up with solutions, right? It's a complete black box, right? I mean, even our quants will tell you they don't know how the price is actually generated. It's done by pure deep learning. That has massive consequences for the market structure going forward, because what is happening is there are a very small number of firms globally that can afford the compute power that you require to build deep learning models. And to give you an indication, like the thing about deep learning is a good analogy for it is you can build a great rocket which will get to Mars, but if you don't give it the rocket fuel, it's never going to get there, right? And you can have all the rocket fuel in the world, but if you don't build a good rocket, it's never going to get to Mars, right? So you've got to be able to do both parts. You've got to have great quants who can build great models in order to initially feed the deep learning models, and then you need huge amounts of compute power. I mean, we are not the biggest by compute power by any stretch of the imagination, but we are investing in building data centers in Finland currently. The first tranche of that is 1.15 billion euros. That's the first of 4. We also potentially look at other locations, HRT, QRT, others are doing similar kind of investments and similar kind of things. And so what I used to think of as being incredibly democratizing deep learning, I thought would be really democratizing, like anyone would be able to do this as long as they got all the data feeds and everything like that. I now realize that it's not democratizing at all. It's going to basically concentrate power in financial markets into the hands of a relatively small number of firms at the top end of the market. And you've got to ask yourself the question, which firms are going to be able to afford that kind of compute power, etc. Clearly, you've got firms like ourselves, like Citadel, like QRT, like HRT, like Jump, maybe, etc. But I think this is a problem for the banks going forward. Honestly, that's my view. It's going to be more and more difficult for them. And I also think it's a problem for the FX market, because fundamentally, no one of those big firms really cares that much about FX. It's a pretty small part of their overall profitability, etc. The biggest profitability globally is always in equities, right? And it's not surprising, because top of book spreads in US equities are $400 and euro dollar trades at like 20 to 25, right? So by definition, things like equities are just way, way, way more interesting. And the price formation is still a long way backwards from where FX is, which is where price formation in liquid instruments is relatively perfect. So I do think this actually has the potential to create big market structure issues and changes going forward. But it's absolutely at the heart of everything we do as a firm.
Ali, from your side?
From my side, I think there's when we talk about AI, what exactly are we talking about? Because the fixed trading language has been around since the early 2000s when it was codified. Algorithmic trading is a logic system that executes trades. Price makers use them. People on the trying to find and hunt alpha use them themselves, and that's been in the marketplace for a very long time. It's not particularly a new technology. When we're talking about the large language models, they are, I think, useful in more retail-related, customer-serviced operations. So from that side, it's not really something that we're going to let touch mission critical. Automation is huge. We have huge amounts of data that we need to collate, understand, organize, and be able to send on. So for that side, the automation is very real. And of course, your model of that XDX uses for the deep learning is also particularly useful. A number of market makers use it specifically for markouts and to respond to client flows. So in the marketplace, I think there is certainly a use for AI and automation, but not necessarily the ones that hit the headlines with the chatbots and stuff like that. That's not touching anything mission critical. But in terms of automation, it's certainly a very powerful product.
Yeah, thanks.
Just to add,
course.
there's an angle here as well from buy side perspective, and that is that we still need to do our best execution from a regulatory perspective, and it's really key that if we are executing in certain ways, that we understand all of this landscape. And so for us at Insight, that's a massive factor.
And so the proof of best execution for you, is that something that can be, how are you doing that? Just for the audience, how are you proving best execution at the moment?
Well, I think I've spoken about this before. There's no one real benchmark, so it's a case of looking at a multitude of benchmarks and providing best execution in that way. Again, I won't bore you with the number of different benchmarks we can have, because that would again take quite some time.
Thanks. So as we move towards the latter end of this year, almost done then, almost less than a month till Christmas, and in terms of 2026, what are you guys, what do you think, where do you think we're going? What will be the key? Well, Jeremy alluded to assets and market developments in maybe products, regulation, tech, etc. And what you guys are looking at, focusing on for next year. If we start for Lee.
Start off with me. So I think equities are going to become a lot more interesting in terms of the marketplace. And we're already seeing a bit of a pickup, specifically in indices as well. I think the market from a retail side comes in cycles. Gold becomes the product of choice. And then you kind of move into indices and then FX. And you tend to see this kind of like cycle between different products being the hot product that retail is trading. So hopefully 2026 brings something other than more gold and more gold.
Jeremy.
Well, I mean, retail trading in the US obviously is super focused on equities. It's a huge market. Roughly 25% of US equities are traded by retail. I would imagine roughly 0.1% of European equities are traded by retail, something like that. It's extremely disappointing that Europe doesn't have a stronger retail market, but unfortunately, I can't really control governments and stamp duty and all that kind of stuff. So we can't really do a huge amount about that. I do think US equity trading for European brokers is a real thing, and I think that's a thing we see growing demand for. I think OTC crypto is highly likely to become a big thing in 26. I mean, it's a little difficult to know the exact timelines around all of this stuff, because you have a tendency to think these things are going to happen really quickly, but actually they often take longer than you think. That said, we're now in that space. We're now providing crypto liquidity into retail firms. I think Japanese retail crypto is likely to take off quite quickly. There are some fairly big changes coming in the Japanese market at the end of the year to capital gains tax regime for crypto, and also leverage, which of course is vital to getting the margin market there really working, the leverage market there really working. And obviously the US, where crypto has gone from being kind of like sort of persona non grata to very much at the heart of government, right? Probably in
Bit too much,
in
perhaps.
too many ways, yeah. But so I think we're talking to all the big US retail brokers at the moment about providing crypto liquidity, not just across the top sort of 3, 4, 5 coins, but really quite deep into the coin universe. And I think that is highly likely to sort of take off. I see equity market volatility remaining relatively high, which probably means it'll be very low next year. But I do think we're still going to have a pretty volatile market. I think FX will be pretty uninteresting, as it has been for quite a long time. Volatility is systematically low in FX. I put that down to the huge growth in the number of systematic traders across the market, particularly in the institutional space. And I think they just sort of kill volatility by trading on super tight spreads. As soon as you see any kind of market trend, there are people on either side of the market in the systematic space, and they just kill sort of big moves until you get something really, really outsized, which would be driven by some huge political event or whatever. I mean, I say uninteresting. Euro-dollar has moved like 20% in the year or something, right? But at the same time, it hasn't been that interesting, right? It hasn't been that exciting other than on a few days. And I don't see a return to really sustained volatility in the FX space, the sort we used to see 15, 20 years ago. I don't see that return happening, unfortunately.
Thanks, Rich. From your side.
So from our side, it's very much keeping our eyes wide open as to developments in the marketplace. I don't think, if we had a pen and a piece of paper, I don't think we could write down what's going to happen next year in terms of crypto, stable coins, all these types of things. But for us, it's being ready such that when the changes do happen, that we're ready to go, and we've got the required people in seats, and also the technology in place that we can when we need to go, we will go. So we've done a lot of research into crypto, and at the minute we're not trading it. It may well be that happens next year. It may well it happens the year after. So we'll just be ready to go when things do change.
Interesting that you're saying it may happen at all. So that's a change. Fazana?
So we are looking to continue our investment in technology and ensuring that we can provide great data for clients. And I think what we've seen is a transition from looking at the spot market in a lot of detail and how we can aggregate that information across various different products, swaps, for example, options. And I think that's becoming more and more important. And actually, we're getting a huge amount of questions from clients about being able to give them that insight to what's happening across the curve. So that's definitely going to be a key theme for next year. And we'll see how the markets move.
Andy?
I think to sort of echo what Lee said, I hope we're not talking as much about gold this time next year. We've seen an awful lot of concentration in it, and hopefully I would still like some volatility in it, but I'd like to see volatility elsewhere as well. So it'll be interesting to see what happens to gold in 2026. I think AI in particular, and AI itself, and also the investment around it, to see the boom bust cycle. Are we going to be, is that going to be 26, or is it going to be further in the future? So I think that'll be an interesting one to watch. And cryptos as well, as everyone's mentioned. I think in 2026 we'll see more traditional players start to come into the crypto market. The yields, when you look at trading on a crypto exchange, it is extremely expensive. And so I think there's a lot of scope there for people who are used to much lower yields in FX to come in and and give it a good go.
Absolutely. Okay, thanks. I think that's been very useful. A lot of themes in terms of where the relationships, AI and its good and bad use cases, and crypto and the growth. But over to the audience. Any questions out there, please? Just get a mic over to you, Sam.
So I'll refrain from asking Rich the obvious question about wardrobe selection. Maybe I want to pick up something that Jeremy was saying. Here's a question for the panel. Why does the panel think, and obviously upstream at large liquidity providers, whether they're banks or non-banks, AI is driving price construction, hedging, and all sorts of stuff. Why does the panel think, even though data itself is now massively democratized, why downstream in the food chain are people not making better use of these technologies in the way they think about consuming liquidity?
Well, personally, I think we're making pretty good use of it, to be honest with you, Sam. So, but downstream, I think the biggest issue is probably ignorance more than anything else, and a lack of expertise and knowledge of how to really use it and how to build the kind of the models to set these hairs running, if you like, right? I also think compute power is a big issue for people, right? And that hence why we see such massive focus on chips and everything like that within the market, right? But ultimately, I don't know. My gut feel is if you run a model which is essentially trying to do something similar to what somebody else is trying to do, but with a less compute power, etc., you're just going to be losing, right? And you're just going to lose fundamentally, unless you have some really different edge that you want to bring to things. Otherwise, the data's the same, right? So yes, it's about how you build the model, but I think a lot of it is about compute power. And I think that is one of the things that makes it so difficult for anyone to really come into the space and use it. Why do more people like not use it in, say, I don't know, like in, I don't know exactly where you're sort of thinking of downstream, but maybe you're thinking of like banks and things like that. I generally think that, you know, banks still view, and sorry about this, Fazana, but I think banks still view technology as a back office product, and I don't think they really understand how to invest in it or understand that it's a real profit driver, right? And that was always my experience in banks, and I don't think it's really changed, right? If I'm honest.
I like to think it's changed. We're definitely making a lot more progress in the technology, because the realization has definitely switched into how important it is to sort of help our clients and make sure that we can automate processes, etc. So I definitely think there has been a bigger shift than I've ever seen over my quite long career
But
now.
that's focused on automation. I mean, Sam's question was really on AI, I think. So,
but there's definitely, I would definitely say, even within the AI space, there is a lot more development going into how it can improve the trading mechanism and other thoughts around how we can leverage that into sort of day-to-day in the more front office environment.
I think as well, when you look at downstream, trying to attract the talent for AI is quite difficult. I would say the top grad coming out of a top university in AI is not actually looking to go into finance at all. They'd rather join an OpenAI or Google or.
That's definitely true. I mean, we actually run a group which is completely orthogonal to our traditional research group in New York, which is called XTY Labs. And XTY Labs is essentially a group of academic quants that we give access to the research data, to the research database, etc. We don't tell them anything about how our existing models work, and just say to them, see what you can do with this and see if you can come up with a completely orthogonal approach to market making, for example. Hiring people into that team, you know, to Andy's point, I mean, for us, it's you know, not the biggest cost necessarily, but like these kids are coming out of school in the US and commanding $2 salary, right? Quite comfortably, right? If you want to be at the top echelons, people who've never worked, right? And you know, they're coming straight out of like grad school or post grad school, and they're commanding like $2, and it's a super competitive market because you are competing with all of the big AI, you know, the generative AI companies.
Wow, very good. I think we just got one more question here. It's just we've got time for this.
Yes, I'd like to ask the panel on AI. I don't totally agree with what you said, so I'd like you to respond to this. In the correspondent interbank world, you have to deal with many banks. If you don't have a direct connectivity to the beneficiary bank, you probably have to go through a number of series of different banks, correspondent banking network management, and you will no doubt have to have done your KYC on those relevant intermediate banks who are going to charge you. The idea of using AI, I would like to think, in a much more generic environment, is simpler, faster, and quicker, and hopefully gets rid of the difficulties of KYC. But the problem is that AI has no emotional intelligence, does it? It doesn't have any inquisitive intelligence. How do they know the policy of those banks that we have to deal with? They're not going to know it unless we feed the data into it. But we don't know either. That's why we go back to having to do our own KYC. So we're stuck in a vicious circle. We talk about the wonders of AI. It's great. But when it comes to second, third, and fourth parties in a chain like network management, where you're dealing with huge operational overdrafts and facilities, and you must know this from HSBC, I've worked with your institution in a correspondent banking environment, you are dealing with major risk. And AI, with the greatest respect to AI, does have no understanding of that. And if you're going to feed it in, you'll be here till kingdom come. So how do we get over that major gap in that particular segment? And I would finally say, if you really drill down, it's not just the correspondent banking world, it's any environment that has a series of intermediary chains along the way. Financial supply chain management is another thing. We're still back to human intervention, human intelligence, and emotional intelligence. And the insensitivity of AI is simply that. it's not a human being.
So I have a bit of a interesting experience in the marketplace because I actually came from Deliverable, where this specific is a very big issue, both using intermediary banks, but also doing KYC to clients and onboarding. And that's where, AI is only as good as the team that's using it. And it's having, MLROs and people who understand the risk, understand the KYC, and have substantially understood what the requirement is, but also developed and understood, Kind fails first stage of KYC. Maybe they're on a FATF red country or there's a issue in the specific workflow. How do you deal with that? And that's having knowledgeable people further down the line to pick up when something falls out of the AI channel, because the AI channel is very good at moving things very quickly across on a specific, if it fits the input, it's going to work fantastically and it's going to require no human intervention. It's going to be done. But when there are issues and when something does fall out of that, that's where you need to have that element of having people who actually understand what they're doing and the process. AI doesn't stop you from having to invest in people who understand the product and the infrastructure in the marketplace, but it does mean that instead of having a team of 60 people do it, you can have a team of 10 experts do it, and they will have the same output.
Back to human intervention. Very thin. I would like
to the huge thing, I mean, you've got no idea how much on a day-to-day basis, how much data we have coming over our in our email boxes or across various portals. Huge amounts of data. Now, the next part is, okay, you've got these huge amounts of data. What's the first thing you got to do? You've got to clean it up. What do you need to clean it up? You've got to have a huge amount of resource. You then clean it up. What have you then got to do? You've got to make sure that the data you're using is the right data and that it's the data you should be using. So again, there's another element if you've got to clean it up, and that requires resource. In my seat, where's that resource? That resource is me. And by the way, I've got a day job, which is to try and do the best I can for my clients. And that is the real crux in the problem. And I think we alluded to it before, talking about processing speed. How much it costs to get the chips through the door is a huge amount of money. And I'm afraid, if you're looking at the financial world, you've got to really break that one first.
I mean, I'm bound to just say I know absolutely nothing about correspondent banking, just to be completely clear. But particularly for markets like FX, and you can see this now, that we actually have the potential where equities is going to actually leap across ahead of FX. But we need to move to a digital backbone for settlement. I mean, this sending gazillions of dollars around the world physically every day is a nonsense. And, when you look at the front office in products like FX, it's truly 21st century. When you look at the back office, you can pick your decade from the 20th century, right? 1980s, people riding around on BMXs, that kind of stuff, for those of us old enough to remember that. That is my characterization of the back office in FX. And if we really want to change that kind of model and really get to the heart of automation, I would say, not AI in that particular space, but automation, then we need to move to a digital backbone. Equity tokenization is a massive conversation topic in the US. Regulators are looking very closely at it, which will probably, by the way, result in a truly 24-hour US equity market, which will be quite astonishing, actually. But I do generally think that we need to move to a digital backbone. I think these days of just having these networks of physical transactions are ridiculous.
Absolutely. Well, thanks, guys. I'm going to have to cut it there. Thanks, everyone, for attending the panel. Thanks to all of the panelists. Been a great one. Cheers, guys. Thank you.